All right, we might as well get started. You guys have had a long day, as have I. Today is on return on invested capital. So of everything that I'm going to be teaching you, or stuff they're going, this is probably, those of you who are interviewing for investment banking, this is what's going to separate you from the pack, because you actually, most undergraduate business schools don't teach this, okay? And they're still backward thinking in terms of how they teach finance. This is really what people who invest for a living, investment bankers, this is what they focus on. If you were to listen to a merger call, you were to listen to an IPO, this is what's really, what is important is return on invested capital. If you were to, so this is what the most, by far, the most important metric that people on the buy side look at is return on invested capital. And importantly, from a valuation perspective, this is essentially how companies are valued today. There's a direct relationship between a company's return on invested capital and its valuation. All right, the higher the return on invested capital, the higher the valuation. And if you were going to, let's say you're at Goldman Sachs and you just started out and you're assigned to an industry team, right? Let's say you're in the household products industry team. This is how, most investment banking firms are, they're organized by industry verticals. You're in the household products team. I'd be willing to bet my bottom dollar they have a list of the 40 or 50 companies that they, cover and that they call on, every month. And they probably have each company listed and they have their ROIC sorted, right? Or they have it listed as a metric. And they probably do a sort. Companies that are at the bottom, this is the calling card for the lead partner to go to the company and say, hey, the industry ROIC average for household products is 25%. You guys are at 8%. Either you do a number of activities to get your returns up, or you are going to get an activist or a rater to come and do it for you. And so Goldman will go in there, JP Morgan will go in there, and they'll say, here are 3 or 4 value-enhancing activities, which is going to increase your return on invested capital. You should sell this division, you should cut capital spending, do this, and do this, and your returns are going to go up. And a lot of companies actually follow, the advice. A number of years ago, Nelson Peltz, who was a activist, actually made a run at P&G and got a couple of board seats and basically forced them to do a portfolio review and get rid of brands, companies that were earning low returns and focus on their, areas of the business, detergent, tissue, diapers, where they earn high returns. Right, so this is, ROIC is what we focus on. Return on equity is a stupid measure, all right? It should be banned from every business school, all right? It's a measure of nothing. This is really what we focus on. And the problem with return on equity is it rewards leverage. When we look at return on invested capital, we are essentially ignoring capital structure. That's hopefully something that is being consistent throughout these lectures that I've done. We want to ignore capital structure when we are analyzing companies. It provides investors an overview of a company's management performance, right? It's a report card on management's capital allocation decisions over time. If a company is doing a lot of acquisitions, right, they're probably paying a lot in goodwill. The goodwill or their balance sheet is growing fairly quickly. And as a result, chances are their returns are declining. Similarly, companies who spend excessive amounts on capital spending, they're asset intensive, their ROIC is declining over time. And what we refer to economic value added is the amount of money created from investing money less the money invested in the company, right? Economic value added tells us how much shareholder wealth is being created. It is a best measure of a company's profitability, takes into account the capital intensity of a business. Only measure that measures whether a company has a competitive advantage or moat, right? The point is that we spent one section on competitive advantage. Does your company or company in question have a competitive advantage? The strategy department will give you, there's many ways of measuring and assessing competitive advantage. We in finance make a determination based on a strategic assessment. We measure it by looking at its return on invested capital. A company really doesn't have a competitive unless it has a high return on invested capital. My own tipping point is an ROIC north of 15% probably means it has a decent competitive advantage, and an ROIC below that in the 8 to 10 to 12 typically means that they don't, right? It also measures how well management has been in allocating capital. Have they done a lot of stupid acquisitions with the excess cash flow, or are they, repurchasing stock and not having to invest it back in the business? We prefer businesses that drown in cash. An example of a different business is construction equipment. You work hard all year and there's your profit sitting in the yard. We avoid businesses like that. We prefer those that can write us a check at the end of the year. Charlie Munger, 2008 annual meeting. What he means is that if you have a business where you as the owner constantly need to put money back into it and there's no money left for you, that's a horrible business, right? We want to own a business where it's throwing off a lot of cash, and this is what companies prefer, right? Economic value added is a measure of economic profit, and we basically, what is the company's return on invested capital, this measure, less the cost of capital. The difference is economic value added. So what it says is a company is not truly profitable unless it earns a return in excess of its cost of capital, right? Last week we discussed cost of capital. This week we're discussing return on invested capital. The difference is the economic value added. And from a purely theoretical perspective, if you were to discount future economic value added back to today, that is essentially, what is reflected in the stock price, right? Companies can sustain strong growth and high returns on invested capital only if they have a well-defined competitive advantage, right? And this is why competitive advantage is so important. Where you start initially as an investor, amount of value a company creates is a function of its returns, revenue growth, and ability to sustain both over time. So why is this so important? If you have a business that's earning 20 to 25% on capital, time is your friend. But if time is your enemy if your money is in a low return business, meaning if you have a company that's generating a 25% return and you really believe that can sustain itself over time, just through the power of compounding, you are going to get wealthy. And I think from Buffett's perspective, even if you slightly overpay or pay a fair price, time is your friend if the company is, compounding at a 25% return. But if your return is below your cost or very low, right, you're not that wealth is not compounding fast enough. Time is your enemy. So if we were to look at companies in the two top quintiles of ROIC, they dramatically outperformed an overall benchmark, like handily, right? Again, time is your friend if companies are generating a high return. And even more dramatic is if we look at companies where the ROIC is increasing versus an index, right? It's even more dramatic. So what does this mean as investors? If we can identify companies that are generating, their returns are going to increase versus stay the same, those are going to be huge money makers for us. And so what does this mean from an investing perspective? If you can identify companies whose either margins are going to increase or capital intensity is going to decline and the returns are going to go up, you're going to make a fortune if you can identify these companies before the market does. And so the point here is this Ball Corp, which makes aluminum cans. The company actually is very focused on economic value added. They've shown over time that their stock price follows, how much economic value is added. Again, EVA is defined as the return on invested capital less the cost of capital, right? Think of ROIC as a rate of growth in shareholder returns over time. The higher the ROIC, the higher the rate of growth in shareholder returns. As an investor, you will pay a higher valuation for a company that is generating a higher ROIC than a company with a lower ROIC. We're essentially paying for higher shareholder returns. So what this means is if you were to walk into Fidelity and they're going to give you two investments, investment A is going to give you a 25% return every year, and investment B is going to give you a 10% return, everyone's going to say, I want A versus B, right? 25 is greater than 10. In the stock market, there's no such thing as a free lunch. The valuation of investment A is going to go up relative to the valuation of investment B, so the two companies are, in equilibrium and from a valuation perspective, right? You can't get that 25% return versus the 10% return for free. Company A is going to be valued much higher than company B, and their valuation will be at parity when A is versus B, as stated, right? So if we were to look at valuation, if we have return on one axis and a valuation multiple on the other, there's a one for it is they're directly linked. The higher the return, the higher the valuation multiple, right? So this whole concept, economic value added, was developed by these two management consultants in the early 80s, and it was a calling card to call on companies and get them to adopt this idea and for them to suggest ways of improving returns. And basically, what they said is that if you are, you're a company, you're a manufacturing concern, or and you adopt economic value added or ROIC as a part of your management compensation scheme, each year, if every person in the company is focused on this, and this is how much EVA you're adding as a company, and you link this to compensation, now your employees and your shareholders are basically, the incentive is directly aligned. And so if we think about the power of pushing this down to the factory floor, if you're managing the factory of a manufacturing concern and you have an option of either investing a little bit of money and eking out a 3 to 4% per year volume output versus building a new factory, and you can do this sustainably every year, then your EVA of that factory is going to be much higher, incrementally expanding capacity versus spending a fortune on CapEx and doing it differently. Also, when we think about it, if the same factory manager and the people under them can pull working capital out of the factory, just-in-time inventory, right, and keep less finished goods there, then again, the economic value added is going to increase. And again, a key distinction between economic profit and accounting profit. Economic profit accounts for the net operating profit after tax, right? Less return on invested capital, less the cost of capital. That is the economic profit. Accounting profit is just, net income, right? And what's really critical about this measure is it links the income statement to the balance sheet. So we're really analyzing the company's income statement, but importantly with the balance sheet. And the balance sheet tells us how capital intensive the business actually is, right? A company is not truly profitable unless it earns a return on invested capital that exceeds its cost of capital. Wealth is created when a firm's managers make positive NPV investment decisions for shareholders, right? The best way to measure value and help management in making decisions that maximize the NPV of the firm. I don't know why this is. Hold on. Now I just totally screwed it up. It's a perfect link between economic profit and shareholder value. We define EVA as net operating profit after tax, or ROIC, less the cost of capital. So ROIC is defined as basically operating income sales less cost of goods sold less the SG&A times 1 minus the tax rate. It is an we importantly ignore the unlevered tax yield of interest expense. We exclude this, right? So in essence, if a company has interest expense, right, we ignore this when we are calculating NOPAT. We need to calculate taxes separately from how, what is reported for the company's income tax expense. So our income tax expense is going to be higher than the company's if they have interest expense because we are excluding it, right? And the importance of this is it allows us to compare companies on an unlevered basis within and across sectors, right? So we're taking capital structure out of this calculation. Cost of capital we talked about last week, and I will discuss more of this next week. But if we really look at return on invested capital and we look at cost of capital, return on invested capital is much more important, right? Investors are going to pay much more for a company's if that spread is increasing because of ROIC versus the cost of capital declining. Right? This ROIC means that the business is getting better. They're going to pay more for that. So the numerator is NOPAT, right? Sales less cost of goods sold less SG&A, operating income times 1 minus the tax rate. This is referred to as NOPAT. Invested capital is the denominator, the amount of capital invested in the business. And there's really 3 buckets. There's net working capital, PP&E, and there's other assets. These are the 3 buckets of invested capital, right? We define net working capital as current assets less current liabilities less cash plus short-term debt. Again, why are we backing out cash and short-term debt from net working capital? Well, 2 reasons. First, cash and short-term debt really have nothing to do with the operation of the business. And secondly, cash and short-term debt influence net debt, which influences the company's capital structure. And we want to remove capital structure from how we are analyzing a company's profitability. Now, I think in core they started to, which is great, look at return on invested capital. I prefer to look at the left-hand side of the balance sheet, the asset side. You can do this calculation on the right-hand side of the balance sheet with debt and shareholders' equity. But to me, as analysts, we want to understand why is invested capital going up and down. And if we look at these 3 buckets, net working capital, PP, and other assets, we can actually put some operational reasons behind whether a company is getting less capital intensive or more capital intensive. And so it allows us to tell a story. If we're focused on the right-hand side of the balance sheet, we have no idea what's going on. So if we look at this simple example, right, a company has operating income of 100, interest expense of 20, taxes of 32, tax rate of 40% of net income, our NOPAT is going to be $100 minus the $100 times 40% to get to 60, right? So here, NOPAT is actually higher than net income because we've ignored the tax impact of interest expense, right? Invested capital is going to be working capital of 50, less cash, plus short-term debt, plus PP&E, goodwill, and other assets. When we take the 60 over the 290, we get 21%, okay? I lost my train of thought. A point on goodwill. We always include goodwill when we are calculating return on invested capital or when we're looking at invested capital. What does goodwill represent? It is an accounting entry, right? So if a company buys a business, they pay $10 billion, and there's $1 billion of book assets. The difference between the $1 billion in book assets and the $10 billion that they paid is $9 billion, and it's reflected as goodwill in the balance sheet. When we're trying to assess whether this is a good or a bad investment, We don't care about what the book value of the business was on the company's balance sheet. We care about how much capital, how much money was paid for the business. So if they paid $10 billion of the business, we need to include the goodwill that's associated with it to truly understand the return profile of that acquisition, right? So if we look at NOPAT over invested capital over time, it's going to tell us a story. We should be able to easily determine how the stock performed without looking at a chart. And importantly, if we're forecasting a business, the direction going forward, it is the ultimate predictor of stock price performance. So what does this mean for investors? Companies that generate positive EVA should see their stock prices increase over time. They are generating returns above their cost of capital. And companies that generate negative EVA over time should see their stock prices decrease. Their ROIC is below their cost of capital. Well, this is a powerful concept. If we were to actually look at the coal industry, the steel industry, the airline industry, these industries and companies perennially have returns that are below their cost of capital. What has happened to these companies and industries over time? They have disappeared. Well, this kind of tells us why. If your returns are consistently below your cost of capital, every day in business you are destroying shareholder value. And for that matter, value for the entire value chain around the organization. Right? Companies that generate positive returns, right, are generating value for the companies, and I would argue value for a greater society. So for investors, let's identify companies that have rising returns, because this is going to lead to share price appreciation, and identify, importantly, managements that think like owners and focus on ROIC. Avoid companies with managements who don't think like owners, right? Most management, this we refer to as companies that are highly acquisitive, right? They are always doing deals, right? Deals are a way of just destroying shareholder value over time, right? Because it's a very high bar to achieve a good ROIC on an acquisition, meaning that the ROIC is above your cost of capital. And the best way for companies to generate value is for internally generated growth with low capital spending. It's a very attractive investment. Monster Beverage is probably the best performing stock over the last 20 to 25 years. Why is that? Very low, very high unit growth, very low acquisitions, and a capital light asset model. You put those all together, you get a gigantic stock. So growth, returns, and cash flow are tightly linked. So what does this mean? Strategies for management. Operate efficiently. Increase NOPAT, right? Net operating without increasing capital. Or if we are going to grow, let us grow profitably and pursue projects that have high returns. Or importantly, purge ruthlessly. So if you own some businesses or divisions that are not earning their cost of capital, these should be businesses or units that you possibly can divest. Why is it when companies announce a divestiture or they're going to spin off a division to shareholders, why do the stocks increase? Chances are what they are spinning off or they're divesting or selling probably has a return that is below their cost of capital, and the market is reacting to a higher ROIC for the new company. So this is a chart that's important to go over. Companies that are already earning a high return can generate more value by increasing their growth rather than their overall ROIC. And companies with low returns can generate more value by focusing on increasing their returns. And this is a powerful concept for us as investors to understand. So what do we mean by this? And this is, by the way, this whole ROIC thing, this is McKinsey. Their entire consulting practice is based off of ROIC. There is a book that I use in all of my classes, which is McKinsey Valuation. If you were to, take one of my classes and read it, the entire textbook is based on this, this ROIC concept. And my view of the world is that they are way smarter than me, than I'll ever be, and just follow people who are smarter than you. If this is how McKinsey, practice is basically practice and the unifying principle, this is what I should be teaching my students. So and this is lifted from the textbook, what this says is a company that's generating high returns, they should focus on growth and not on growing return. So you have a company that has a 60% ROIC, you should be focused on growing that business and not on increasing the return profile. Conversely, you have a company that has a mid to low ROIC, you really shouldn't be focused on growth. You should be focused on getting a higher return profile. So how does this come to fruition? So there's a couple examples I use in some of my classes. So if you look at Google, when Google went public, they had an ROIC of like 80%. And this is back in desktop search in 2004, 2005. Desktop search was a very profitable business. It generated a 90% ROIC. 10, 15 years later, their ROIC went from 80% to 40%, yet the stock went up 10 or 15-fold. So how is it that the company's market cap increased tenfold, yet the return profile declined some? Well, the reason is mobile. Mobile came about. Mobile actually generates a returned ROIC in the 30 to 40% range, well below that of desktop search, but it was still very attractive. As long as management teams pursue projects that have a return profile in excess of their cost of capital, they should do it. And so what Google did is they sacrificed returns for growth. The projects, so if they're using mobile and some of their acquisitions they did, generated very high returns, just not at that 80% level. So if we were to look at a ROIC profile of Google, it went down, but the revenues and cash flow exploded. So here's a Coke, and so Robert Guzetta, who took over Coke in the late 80s and turned it into the powerhouse it is today, he adopted EVA on day one. It used to be, and this is again the power of pushing it down to the factory floor, it used to be Coke used to ship concentrate in stainless steel containers. This was a capital item recorded on the balance sheet. And what they did is, and his team at the factory floor did an analysis, if we switch shipping concentrate to cardboard and we sell the steel containers to reduce invested capital base, even though using cardboard containers is going to reduce operating income and operating margin, the reduction in invested capital was much higher. And in the end, the ROIC went up from this one very exercise, right? So again, if people in management follow whatever the incentives are, if your incentive is to increase economic value added, the management teams will actually follow this. Other examples, manage working capital much more efficiently, right? Speed up production lines with minor tweaks versus building a new plant, cut costs to be more efficient, or sell a division that is not earning its cost of capital. Again, many companies have adopted EVA across the entire organization. This is how their bonuses are determined. It's just not for top management. We push it all the way down to the factory floor. This is how significant value can be created. It's a great way to reward management, not entirely stock market focused, right? If your EVA increased, you are going to get a bonus irrespective of how the stock performed. Over time, EVA creation and stock price will follow one another, and this links the interests of management with shareholders, a longer-term focus. Okay, let's go through, that was super fast. Let's go through a couple examples. Here is, and this is how we like, and I have a couple of examples posted. This is how we like to look at it. So operating income, this comes directly from our model, operating income, right? 2022, $114.3 billion. $114.3 billion. we calculate, we take pre-tax income, whatever it is on the income statement, we take taxes and we calculate the effective tax rate. Now in Apple's case, we're ignoring interest income, but many companies have interest expense, but it's the same idea. We calculate no-pat taxes by taking this 14.7% and multiplying it, right, G86 operating income times the effective tax rate. We get taxes, and now we have no pat, right? Invested capital, right, again, we like to put it into three buckets: net working capital, PP&E, and other assets, right? Anything below PP&E, we typically include in other assets: goodwill, deferred taxes, investment in subsidiaries, et cetera, we always include it. The only time we're not going to include a long-term asset if it's referred to as a marketable equity security. Many instances, this is the company taking their cash and investing it in a security that has a longer life than 1 year, so a 2-year treasury bill, right? That will, and especially like in Apple's case, right, they will invest in securities because they don't need the cash that have a 2-year time horizon. They mature within 2 years. They're forced to list it as a long-term asset, even though it really is a cash and equivalent. So here, net working capital, what do we do here, right? G65, current assets less G75, current liabilities, right? We subtract cash and equivalents, and then we add short-term debt. And this gets us to net working capital. PP&E comes directly from our balance sheet, right here, and then other assets, which is grouped here. And now we get invested capital. And we take operating income, our NOPAT, we take net operating profit after tax divided by, importantly, we take NOPAT divided by the average invested capital over the year, because we want to, take out short-term fluctuations in invested capital. So it's NOPAT divided by average invested capital to get our return on invested capital. So if we look at Apple, this is like the highest ROIC out of any company I've ever come across. And this is the importance of analyzing a company both strategically and financially. So here, well, why is this company's ROIC so high? Well, first of all, if we look at the funds flow statement, capital spending is tiny. They outsource production, right? They outsource production, to China, so they, to Foxconn. So their PP&E, relative to the size of their profitability and revenues, is tiny. They really are not in the business of manufacturing, right? Net working capital is negative. Well, how can this be? People are dying to do business with Apple, right? They get paid up front for a lot of the business that they do, right? So receivables are tiny. And they typically don't have inventory. That's on Foxconn's balance sheet, right? And they get paid up front, which means many times unearned revenue is going to be very high. So net working capital is negative. When you see a negative net working capital, that typically means it's a great business. The company has a very strong competitive advantage. And so what we want to do is see, how has this changed over time? It's always been high. Well, we're going to analyze, different changes in it. But Apple, by far, probably has the highest ROIC of any company. Let us look at Meta, Facebook. And this is, I don't think, with the exception of Nicholas, anyone's in like, I'm kind of stealing my thunder for this is a case study I'm using on Wednesday. Meta's ROIC went from 63% to 27%. How do you think the stock price performed when this happened? It went down like 70%. Well, what happened? What has analyzed the components of it? What happened here, why did its ROIC in 2022 go from 55% to 27%? Well, the first thing is NOPAT. Let's go up to here. NOPAT got crushed. Margins, operating margins declined because of pressure on its pricing, because of the privacy change that Apple put in place. So this was, again, we try to break it down into different buckets. This was really the predominant decline. And how did the company respond to this ATT change, this privacy change? They ramped capital spending. Capital spending went from 18 billion to 31 billion. So if we look at the components of invested capital, PP&E went up from 57 billion to 79 billion. Right? So Meta in 2022 got hit both ways, right? Their business became more capital intensive. They needed to invest in AI to offset the Apple privacy change, and their margins got obliterated. So the ROIC went from 55 to 27%. And now what we're seeing post this change is that the company is now, basically back in action, or is got its mojo back through investments in AI, which make the ads more relevant. So their pricing per ad now, after declining, is growing and growing nicely. So now margins have gone from 24% to this year, it's probably at 41%. However, what has happened to the company? They've had to invest a fortune into AI to make the ads more relevant, but the increase in profitability has more than offset this. So their ROIC has gone from 27% to 49%. If you were to look at this, if you knew this was going to go from 27% to 49% in 21, you would have bought the bejesus out of the stock, right? You knew it was going to go up. Again, this should tell a story about what is happening to the company. And by going through each bucket, you can kind of, net working capital, PP&E, other assets, and then looking at margins and revenues, you should be able to understand what is actually happening to the company. Here is a Gillette, a company I used to follow that I actually owned as a fund manager. And this is a turnaround. The company was mismanaged. And they brought in an outsider to come who had experience in consumer packaged goods companies. And we can see the turnaround in terms of what he was able to do. So NOPAT was flat to negative. And then the CEO came in. A new CEO came in, grew revenues, and grew margins. So NOPAT went from $1 billion in 2001 to $2.2 billion in 2005 through a combination of revenue growth and margin expansion. And the company, horrible at managing net working capital, and basically effectively managed net working capital and took it from, call it, $2 billion down to nothing in 2005, cut capital spending dramatically, so PP&E did not grow, and basically didn't really do that many acquisitions. So here, NOPAT basically doubled from $1 billion to $2.2 billion, while invested capital remained constant. And so the ROIC went from 14% to 32%, right? And this is the importance of analyzing a company strategically and financially, right? Here is what the this is what the, this ROIC analysis tells us. And then we go and look at what actually is happening to the company, both financially and strategically. So here we can see what he was able to do on the margin side. Margins went from 18% all the way to 26% while he grew. So a great case study in terms of what improving returns can do to a stock. Kimberly-Clark, right, they make tissue, diapers, etc. It's a company I've followed for a long time. Here's its ROIC profile. Again, we like to look at net working capital, PP&E, and other assets. Gives us an understanding of what actually is happening to the company. So it was, company has done a really good job of managing invested capital. What happened in 2021, 2022, basically, with COVID, their costs got out of their costs, the inputs, raw materials went up a lot. Their gross margins collapsed by 600 basis points, so their profitability declined. And we can see this in looking at what actually happened to, NOPAT in this time period, right? It went from 2.7 to $2 billion. We can see that in the gross margin line. However, the company has done, did what it could in managing net working capital and overall, PP&E, and so they kind of mitigated this to a certain extent, right? Yes, the returns decline, but we give the company an A for managing invested capital. And this year, through the cost controls, now their returns or their profitability is increasing, and so the returns have increased. So again, I like to look at it both from a NOPAT side and an invested capital side. NOPAT, what drives NOPAT is growth in revenues and margins, right? This is the first thing. That's the numerator. The denominator, 3 buckets: net working capital, PP&E, and other assets. I did miss one thing, 1 second. And in terms of what an acquisition can do to a company, and this is, again, what I use and what am I, here is Procter & Gamble. So Procter & Gamble purchased Gillette in 2005. In 2004, Procter & Gamble generated a NOPAT of $6.8 billion. They had invested capital of $38 billion. So they, pre-Gillette, had a respectable ROIC of 18%. You can say that the company had a competitive advantage. They purchased Gillette in 2005. At the time of 2005, Gillette had a NOPAT of $2.2 billion. They paid $57 billion for it. So the ROIC pre-cost savings or revenue synergies was 3.8%. Even if they were to double NOPAT, now we're talking, 7.6% ROIC, still below their cost of capital. And if we look at just the insanity of what they were thinking, so the acquisition price, or what invested capital increased by, of $57 billion, is greater than the entire invested capital base of P&G in 2004, yet the NOPAT was a third of what their NOPAT was in 2004. And so this crushed P&G's return profile going forward, and it's why that activist Nelson Peltz came in. So they dramatically overpaid. And the craziness of this acquisition is the last time the Gillette had NOPAT or profitability of $2.2 billion was in 2005. As soon as they acquired it, pricing in the razor business went to hell. And I'd be willing to bet today this is probably $800 million, right? So we can see, why most large acquisitions don't even come close to covering their cost of capital. So just to summarize what we just talked about, and I think I posted a number of examples for you to follow and use for your companies. So the market is very efficient at valuing companies based off of their ROIC. In fact, there's probably zero arbitrage opportunities, right, in buying company A and shorting company B based on their return profile and valuation. However, what the market is not efficient at is predicting change in ROIC, right? So from an investing perspective, if you can anticipate this through talking to the company, you think they're going to pull working capital lower, become more efficient in managing their inventories and receivables, or you think the capital intensity of the business is going to decline for whatever reason, or they can improve margins dramatically. These are all things that is going to cause returns to go up in the future, and so you should get ahead of. Again, the example of Meta, we saw what happens to a company, when their returns decline, the stock collapses, and to Zuckerberg's credit, he put in a number of changes, and now the returns are back up to where they were historically. But really, predicting the ROIC change is everything in investing. And just to review the Google example, everything being held constant, yes, declining ROIC typically means a declining competitive advantage. You need to be cognizant of the fact that sometimes a return profile for a company will decline just from a mix effect. And this is where you've got to ask management, why is your returns declining? If it's a mix shift towards a lower ROIC business, but that ROIC business they're investing in still generates high returns, that that can be a winning investment. Again, returns and valuation are directly linked. A company is not truly profitable unless it earns a return above its cost of capital. And we'll get to this next week, but really returns, a company's return profile is directly related to its degree of financial leverage, and I'll explain that next week. Any questions what I went over? Fairly quick. Usually it takes me 2 classes to get through this. I did it in 50 minutes. Yes?
When you're using the average of invested capital to get ROIC, is there really big fluctuations between 2 years?
That's why we average it out. We're trying to average, because companies' invested capital is going to go up or down year to year, and we're just trying to average out that increase. But in general, it's not going to big up or big down typically unless there's a big change in profitability. Any other questions? Again, I will post, if I haven't done already, and I remember some models or how this is calculated. So it'll give you a template to for you to do yourself. Mistakes that a lot of students make is they don't include goodwill, they don't include other assets, and they don't subtract out short-term investments, right, from working capital. So cash and short-term investments are not part of net working capital, so you need to exclude this. Net working capital is really the capital that's required to run the business. Receivables, inventories, less payables, and accrued expenses. And always include goodwill. Nicholas?
Same as last week, Professor. What might you ask in an interview to really dig into ROIC?
So, I mean, if you start to talk about ROIC in an interview, you're going to blow the interviewer away. And so the critical thing to take away from this is that returns and valuation are linked, right? Companies that have low capital intensity tend to have very high returns, and the market rewards these companies. Why is it that software companies have gigantic multiples? There's no CapEx, right? They are capital-light business models. So capital-intensive business models, heavy machinery, oil and gas, right? Those companies sell at dramatically lower valuations versus companies that, so let me, one other spreadsheet. So that's super, if you can communicate that in an interview. Here we have companies in the same industry, and again, if you were to work at Goldman Sachs, chance, or one of the other banks, you may have an industry like this. Now, there are some variations, but most people would say, Colgate sells at 16 times market value, enterprise value to EBITDA, and Kimberly-Clark sells at 12 times. I am going to short Colgate and buy Kimberly and make money in the arbitrage, right? This is how most finance professors would teach you. That's like, financial suicide, right? Why does Colgate sell at a premium to Kimberly-Clark? Well, it has a higher return on invested capital, right? It has a higher margin. It has higher revenue growth, right? So the market, again, is ruthlessly efficient at taking this information and turning it into a valuation, right? So it's super helpful to have this basic information laid out so you can understand, well, actually, Kimberly-Clark appears to be fairly valued relative to that of Colgate, right? Colgate has higher margins, higher returns, and higher unit growth. As a result, it should be valued higher than Kimberly-Clark, right? And so this is how companies are valued today, right? And we'll get to valuation in a couple of classes. And this is why I'm getting way off kilter. Why I hate DCFs, and I like to value companies on a multiple of EBITDA. A DCF gives you one number, like what is the stock worth? This gives us a comparative analysis of company A versus company B versus company C versus company D. So again, companies, the higher the return, the higher the valuation, the lower the return, the lower the valuation. If you want to get a higher valuation as a company, you should try to improve your return profile. So that's what I would communicate to the interviewers. Lower capital intensity is always rewarded in the stock market. It means there's more money coming into your pocket as a shareholder. All right, thank you. You guys are troopers. Take care.